I would like to remind you that I am not a financial advisor. Anything I say here is for education and entertainment purposes only. You can and will lose money if you don't do your own research. Market gaps. What are they and how are they used? Gaps are areas on a chart where the price of a stock moves sharply up or down with little or no trading in between. They can occur in any time frame, and they are normally analyzed by comparing the previous candle's closing price to the current candle's opening price. Strong gaps are considered to have a 5% or more price movement from the previous close to the current open. Many strategies are built around gaps. Some are for intraday trades, others are for long-term swing trades. A strong catalyst such as FDA approval, earnings, big corporate news, or a major macroeconomic factor can cause a stock's price to gap up or down. Lack of liquidity and change in market sentiment can also result in market gaps. Small gaps are fairly common and occur almost every day, but could be more pronounced after a weekend due to the extended market hour closures and possibility of news catalysts over the weekend. Gaps can occur in many ways or not occur at all. The type of gap, up or down, can be seen as strong or weak relative to the previous candle's close and the new candle's open. The significance of a gap is greater when accompanied by an increase in volume. Some traders will consider a gap to be filled when the price of the current candle reaches the closing price of the candle that came before the gap was made. Others will consider the gap to be filled when the price of the current candle reaches the high or lows made by the wick of the candle that came before the gap was made. Gaps are normally classified into four types: common, breakaway, continuation, also known as runaway, and exhaustion gaps. Common gaps, as the name states, are quite common. These types of gaps normally get filled fast. They are not created by strong catalysts and can occur on high or low volume. Breakaway gaps are gaps that occur through a resistance or support level. These types of gaps can sometimes signal a trend reversal or continuation of a trend, and they are believed to be more significant when accompanied by strong volume or a catalyst. The continuation or runaway gap is usually seen once a trend has been established and investor sentiment is picking up, with fears of a strong pullback going away. There is normally a strong catalyst and strong volume that help fuel this type of gap. The exhaustion gap is seen as a gap that can signal the end of a trend, normally occurring after several days or weeks of strong price movement in one direction. These types of gaps can be large, but will normally have very little follow through on price action. Gaps are not limited to one time frame or direction. It is possible to see multiple types of gaps on a particular chart for the same time frame. As I mentioned before, many strategies are built around gaps. A very popular strategy used by day traders is the gap and go strategy. There are many variations of the gap and go strategy, but the one I like to use quite often is the morning high-low pullback to hold the gap strategy. This is where the opening share price of a particular company has a significant gap up or down from the previous day's close. The trader will wait for a morning high or low to be put in on high volume, then wait for the pullback to come close to or near the gap opening price on decreasing volume. And if the price holds as support or resistance on stronger volume, depending on the gap type, the trader can enter a position. Aggressive traders will enter earlier for a greater risk to reward ratio. More conservative traders might wait for greater confirmation before entering the trade. When it comes to gaps, some key takeaways to remember are that gaps are created when price has a sudden move up or down from one candle to the next. There can be multiple gap types within a time frame and direction. Gaps accompanied with above average volume can signal additional strength in the move. Gaps without a strong catalyst do not tend to hold direction, and that many profitable strategies are built around price gaps. If you found this information helpful and would like to see more videos like this or get notified when I release a new video, click the like, subscribe, and notification buttons. Leave a comment below if you would like to see videos on a specific topic. Thank you for watching and have a great trading week.